Warren Buffett says The Intelligent Investor is the best book on investing ever written. And he literally said reading this book at 19 changed his whole life. When I read it, it kind of changed how I see money forever too. Because this book doesn't teach you how to predict the market. It won't sell you some secret formula to get rich overnight. What it really teaches is how to think about money, investing, and risk in a way that keeps you safe and helps you actually build wealth long term. And today I'm breaking down the 5 biggest takeaways from it, the ones that will save you from a lot of pain, help you avoid dumb mistakes, and finally show you what it really means to invest intelligently. Takeaway number 1, Mr. Market. Let's kick this off with probably my favorite idea in the whole book, and it's the one most people screw up the worst. Imagine you own a small local coffee shop. Nothing fancy, but it makes good money, regular customers, steady profits. You love it. Now, every single morning, this weird neighbor, let's call him Mr. Market, comes rushing in with a wild new offer to buy your coffee shop. Day 1, he storms in. "I'll give you $1 million for this place. Coffee shops are hot right now." You're thinking, sounds insane, but noted. Next morning, Mr. Market drags himself in looking miserable. "Coffee's dead, man. I'll give you $50,000 tops. You should sell before it's too late." Day after that, he's back. "Good news, $700,000. I changed my mind again. Coffee's cool now." And this goes on every single day. Now here's the key question. Would you take him seriously? Of course not. You'd laugh. You'd roll your eyes. You'd say, "Bro, come back when you're sober." But weirdly, when it comes to the stock market, people listen to Mr. Market like he's some kind of financial wizard. Stocks go up, everyone's suddenly a genius. Stocks go down, everyone's crying and selling. Why? Because the market looks official. It's on screens, it's on the news, it feels serious. Graham's point is, Mr. Market's behavior is no more rational than your crazy friends. He's emotional, he's dramatic, he's obsessed with fear and greed, and most of the time, he's wrong. You don't have to sell your coffee shop just because he's feeling moody today. Same with stocks. So what's the smart move? Use Mr. Market's mood swings to your advantage. When everyone else is panicking, prices drop. That's when opportunities show up. When everyone's greedy and throwing money at stocks like it's free candy, maybe it's time to chill and not overpay. Think about this. During the 2020 crash, great companies like Microsoft, Apple, and Amazon got way cheaper. Not because they suddenly became bad businesses, but because Mr. Market was having a meltdown. The people who understood this principle didn't panic. They saw an opportunity. This is what Graham means when he says, "The market is there to serve you, not to instruct you." Your job isn't to predict where prices go next week. Your job is to understand the value of what you own and act only when it makes sense. That's how you win long term. Not by trying to time every move, but by knowing when to sit tight and when to take advantage. Takeaway number 2, stop speculating. Alright, let's clear this up. Investing is not the same as speculating. Let me explain. Investing is calm, thoughtful, long term. It's like buying a house you actually plan to live in, raise a family in, build memories. You check the neighborhood, the plumbing, the schools. You don't just buy it because the price might go up next week. Speculating, though, that's like buying the house just because your barber said prices are going to the moon. No idea what it's worth, no clue who lives next door. You're just hoping someone else will pay more than you did. And that's the danger Graham warns us about. See, investing means 3 things. You do your homework, you protect your money, and you expect a reasonable return. Not 10x overnight. The problem is, most people think they're investing when they're really just speculating. They chase hot stocks, meme stocks, headlines. They're buying because someone on YouTube or TikTok said so, not because they actually understand the business. Let me ask you something. If I offered you a tiny piece of a pizza shop you've never seen, don't know the owner, no clue if it even sells pizza, would you buy it just because I said it's going to blow up? No way, right? But people do that with stocks every single day. Here's a famous example. In the dot-com bubble of the late 90s, people were throwing money at anything with .com at the end. Didn't matter if the company had 0 revenue. Didn't matter if they sold nothing but dreams. Prices skyrocketed and then everything crashed. Why? Because people weren't investing. They were speculating, hoping to get rich quick off hype, not value. Graham's golden rule is, treat a stock like a part ownership in a real business, because that's literally what it is. You're not buying a ticker symbol or a lottery ticket. You're buying a piece of a real company, with employees, products, revenue, good months, bad months, just like any normal business. And if you wouldn't buy the whole business, why buy a tiny piece of it? That's the mindset shift. This doesn't mean you can't ever take risks, but if you do, you better know why you're doing it, what it's worth, and what your downside is if things don't go your way. Investing is boring at times, sure, but boring builds wealth. Speculation just builds screenshots of your account right before it crashes. If you treat stocks like businesses, not scratch cards, you're already way ahead of most people. By the way, if you're loving this so far and getting some good ideas out of it, do me a quick favor. Hit that like button, Maybe even subscribe if you want to see more videos like this. All right, back to business. Takeaway number 3, margin of safety. Let's make this super clear, because honestly, this is one of the smartest things Benjamin Graham ever taught, and yet, almost nobody talks about it properly. Here's the big idea. Don't pay full price for anything, especially not stocks, because no matter how smart you are, no matter how well you research, things can go wrong. The economy can flip, a company can mess up, the market can panic for no reason. You need a cushion. You need room for error. Think of it like this. If you're building a bridge and the trucks crossing it weigh 10,000 pounds, do you build the bridge to handle exactly 10,000 pounds? Of course not. You build it for 30,000, just in case. That extra strength is your safety margin. Same with stocks. Let's say you figure out a company is worth $50 per share. But are you buying it at 50? No, not even at 45. You wait until it's at $30 or less. That gap protects you. It gives you breathing room if something goes wrong. Look at 2008. During the financial crisis, people were dumping stocks left and right. Solid companies like Johnson & Johnson, Coca-Cola, and others were trading way below their real worth, just because people were scared. That's when guys like Warren Buffett were buying like crazy. Why? Huge margin of safety. He wasn't guessing. He was grabbing value on sale. And here's something people always ask. But what if I love a company and the price just keeps going up? Great question, and it happens all the time. Let's say you love Apple. You've done your homework, you believe in it long term, but the stock keeps running higher and higher. It's tempting to just jump in because FOMO, right? Don't. A great business at the wrong price is still a bad deal. If it's too expensive right now, you don't chase. You stay patient. Put it on your watch list. Follow the business, not just the price. Wait for Mr. Market to throw one of his classic mood swings again. And trust me, he will. That's when you strike. Warren Buffett once said, "The stock market is designed to transfer money from the impatient to the patient." Your edge isn't just knowing what to buy, it's knowing when to buy. You wait for that price where you've got room for error, where the risk is low, and the upside is solid. Takeaway number 4, pick a side. This next idea from Benjamin Graham is super important because it saves you from years of confusion and frustration. It's this. You're either a defensive investor or an enterprising investor. There's no middle ground. Let me explain this in the simplest way possible. Imagine 2 types of people at a gym. One shows up casually, jogs a little, lifts a few light weights, feels healthy, goes home. They're not trying to compete in bodybuilding. They just want to stay fit and not injure themselves. That's your defensive investor. The other person? They've got a plan, a coach, a meal prep routine, supplements. They track every workout. They want results, they want gains, and they're putting in serious time. That's your enterprising investor. Both are fine. Both are smart, as long as you know which one you are. If you're defensive, here's what that looks like. You don't chase stocks. You don't time the market. You don't treat CNBC like breaking news. You buy broad, boring, beautiful index funds like the S&P 500. Maybe sprinkle in bonds depending on your age. You invest consistently every month, whether the market's up, down, or sideways. That's dollar cost averaging. You check your portfolio once a year, rebalance if needed, and then you let compounding do its magic. This is how most people win long term. But if you're wired differently, if you love digging into businesses, reading financial statements for fun, hunting for undervalued stocks like a financial detective, then cool, go enterprising. That's what Warren Buffett used to do when he was younger. But know this, it's work, serious work, and it's not for most people. Graham was super clear on this. If you don't have the time, skill, or interest to research properly, be defensive. If you're obsessed, disciplined, and willing to outwork everyone else, go for enterprising. But don't try to play in the middle. That's where people get wrecked. They end up chasing trends, buying high, selling low, panicking when things drop. That's how people lose money and confidence. Takeaway number 5, emotional discipline. Let's talk about the part no one wants to admit. Your emotions are probably your biggest enemy when it comes to investing. Benjamin Graham was very, very clear about this. He said the difference between successful investors and broke ones isn't intelligence, it's emotional discipline. We've all seen this happen, right? The market drops 5% and suddenly everyone's acting like it's the end of the world. People start panic selling. Oh no, my stocks are down. Buddy, they were up 40% last year. Chill. Or the opposite. Some random stock explodes overnight. Everyone's making memes, flexing screenshots on Twitter. What happens? Greed kicks in. FOMO takes over. You think maybe I should YOLO into this too. Look at history. Markets crash, rebound, crash again. Take the dot-com bubble in 1999, or 2008 financial crisis, or 2020. Some people panicked, sold everything. Some stayed chill, kept buying great businesses, ignored the noise. Guess who came out richer a year later? It's not about predicting the future. It's about keeping your head when everyone else is losing theirs. Because here's the truth. Markets will go up, markets will go down. Sometimes for reasons that make no sense at all. Your job isn't to control the market. Your job is to control yourself. And how do you do that? Have a system. Dollar cost average. Rebalance. Stick to your plan. When you've got rules, you don't need to make decisions based on panic or hype. Think of it like flying a plane through turbulence. The pilot doesn't start yanking the wheel because of a little shake. They follow the system. Same with investing. Alright, let's wrap this up in a way that actually helps you when you go back to your money. Think of these 5 takeaways like parts of a puzzle. They work best together, not alone. First, you gotta treat stocks like owning a real business, not some magic ticket to fast money. Every time you think about buying something, ask, would I be happy owning this for 10 years, even if the price didn't move tomorrow? If not, skip it. Simple. Then, you protect yourself with the margin of safety. Don't chase stocks when they're running hot. Be patient. Wait for the price to give you a cushion, not a heart attack. This saves you from costly mistakes. Next, when Mr. Market throws a tantrum, you don't join the drama. Let others panic. You stay calm. Sometimes the best move is doing nothing. Then figure out who you are. If you don't want to babysit stocks, stick to index funds. If you love digging deep, go for it. Just commit. Don't float somewhere in the middle wasting time. Finally, master your emotions. This is the glue that holds everything together. Without discipline, none of this matters. Build habits that make it automatic. Dollar cost averaging, rebalancing, and ignoring the noise. If you use these together, they protect you from yourself, from hype, and from market madness. That's how this becomes practical. And hey, this book is a monster. What we just covered, that's barely scratching the surface. There's so much more inside. So if you want me to break down more lessons from this book, if you want a part 2 where we dive even deeper, drop a comment below and let me know. Like the video if this helped, and I'll see you in the next one.